Shaun again here with Peterson Wealth Services. Welcome to our first point of view video of 2022. Today is January 4th. We're here and it's looking like it's going to snow outside. We're going to send out a video today and just give you our outlook for this year, give you a bit of a summary of where we came from last year, or maybe a few years before that, and why we're at where we're at today in the economy, and potentially some bumps that we might see along the way. So let's start right now. I'm going to put up a chart. Kate's going to put it up, and it's going to give you a background on valuations. So this might look a little intimidating to start with, but bear with me for a second. I'll explain what you're looking at. Right now, this is a snapshot of the returns by value and valuations by style of asset class. So what we're looking at there is a 10-year annualized valuation on the left side. So it shows across the top value, blend, and growth, and then along the side, large companies, mid-sized companies, and small companies. This is a way for financial advisors to kind of analyze or dive into where the market seems to be most favorable or attractive and where it's getting more expensive. So let's take, for example, go over there to the large growth category. That box shows 19.8%. That's the 10-year annualized PE ratio of what we're dealing with. Excuse me, that's the return ratio, I should say, not PE yet. We're not dealing with PEs until we go over to the right. But this is the return, 10-year annualized return. Large company growth stocks have averaged almost 20% per year. Now drop down to the small cap value, and that area has averaged 12% per year over the last 10. Now you can scoop right across to the right there. It shows 2021 numbers, and you can see again growth outperformed for the most part. Small company growth, however, did very poorly in consideration to the rest, in comparison to the rest. So that's one area we're kind of watching, scratching our head and going, why? Well, I think the biggest reason why is the inflation and interest rates. But let's continue on with this chart. It just shows you the returns since the market dropped in March of 2020, since the market low. So almost every single asset category has doubled since that market low, and that's only been less than 2 years ago. You can see how quickly the market can turn and go up. And finally, over there on the right, the current PE versus the 20-year average. PE stands for price to earnings ratio. That's a way that we measure how expensive an asset category is. So a typical PE ratio for the S&P 500 is around 13 to 14 times earnings. We're paying about 13 times earnings for every dollar of earnings the S&P generates. In the last 20 years, these valuations have become a little stretched, especially large growth. You can see large growth PE over the last 20 years has been 30.5, and that's the current PE. The average over the last 20 years is 18.5. So we're well above the long-term averages where we are standing currently, and that's even more so for small growth, which has had a bit of a correction, if you will. So we're watching all these areas and trying to determine where areas have the most reasonable valuations. A lot of these areas are expensive by price, and we're going to expect some sort of a pullback soon.
Yeah, and I think that's important as we go into 2022. Looking back at 2021, we didn't really see a lot of volatility, and we always try to caution investors and our clients that we can't get complacent. We can't just expect to open up our monthly statements and see an increase every month. Volatility is part of investing. We've said that all the time. It's something we have to expect. Last year, I'm going to have Kate throw up another chart, and this shows the S&P 500, its annual returns and intra-year decline. So jump right to the right of this chart. Our intra-year decline last year was negative 5%. That, guys, that's really nothing. We usually see a 10% correction at least once a year and a 20% every 3 years. So what I'm trying to get at here is expect to go back to the normal at some point. And when that happens, it's not a point of, oh, the market is crashing. I dislike that term. Crashing is crash and burn and it's all over. Yeah. That's not what we mean when we say volatility or a correction. A correction is just a 10% drop in values. And when do you lose during a correction? If you sell.
It's temporary.
It's temporary. So Billy talked about that March correction, actually kind of sent us into a recession. People that sold during that March drop, they lost. And then they missed the doubling period on the upside of that. People that bought during that time period, either going into their 401k or they had cash on hand, their returns are better than what Billy even talked about in those scenarios. So it's out there. It can happen at any time. I think Billy's going to talk about maybe some things that might put us into a little more volatile market.
Yeah, I mean, there's some things that we could expect, and our anticipation this year is you're going to see the Federal Reserve have to raise rates multiple times. We've talked about this in our videos, and we've been preaching this for a long time now, it seems like. Mm-hmm. But inflation is here, and one of the only ways to offset or combat inflation is the Federal Reserve raising interest rates. They raise the borrowing costs to everyone out there in the economy, and it effectively puts the brakes on spending. It's what they're trying to do. They're probably a little behind the eight ball right now. They haven't started yet, but the fear is in the marketplace is they're going to start raising and have to do it quickly, and faster than the market is ready to absorb that. So we're at zero essentially right now on the Fed funds. We're going to see the Fed funds probably go to 2.5%. I don't know how quickly they're going to get it there. I mean, that's the debate right now in our world, and we hear a lot of economists with different opinions. But you are going to see the Fed start talking about raising rates. And that is going to be something the market doesn't want to hear. So I anticipate the market to correct, or that's going to be probably the catalyst to have this, our first 10% correction of the year, our first one in quite a long time actually. Be prepared for that kind of stuff. Watch it, call us if you need to, but don't be alarmed by it. Matter of fact, try to turn that into an absolute advantage for you if you're ready for that and can invest dollars when the markets are going down. This doesn't mean that we're running for the hills and exiting. Matter of fact, we have a little more cash on hand in anticipation of this than we normally would. So going into the end of the year, we raised a little bit more cash to prepare for this type of stuff. We're just telling our clients, get ready for it. We need to have it. It's normal. You can't keep going up like this forever.
Yeah.
People don't call us when the markets are going up. They only call when they see their value drop, right, Shaun?
That's right, and that's okay. That's what we're here for. But we're always going to be that captain of the ship and saying, hey, we've been through this before, and we're going to guide through that because it's definitely an emotional time, and people get nervous and they get scared. But the point is that we always come back to it's what you do during that period of volatility that really matters. And I want to just piggyback off what Billy said. When we raised some cash, we took that from areas of the market that we thought were overvalued. So we brought some of our growth funds down, our holdings down, and moved it into a little bit of cash, and even added some into our value, more dividend-paying investments that we have in our models. Yeah, a little bit of rotation, and you're seeing that rotation. I mean, you're seeing the Dow is up. Dow is value, dividend-paying companies, and Nasdaq's been kind of beat down a little bit. So I think earnings going into 2022 are going to be very important. People are going to look for that in companies. A lot of these IPOs or these, I'm going to call them risky tech companies that have kind of taken off. Well, if you don't have earnings and you go into a recession or you have high interest rates and high borrowing costs, it'd be very difficult to turn a profit. And the wage growth too is just insane. I mean, we talk to our business owner clients and they're trying to hire people. You can't get people in your door to work without paying them a very high wage, which that's an input cost, and it leaks down to the consumer, right? And all the products that we buy. So we're seeing higher costs and everything, and it's probably going to continue for a while.
Yeah, we anticipate that to stick with us for a while here. It's not going to correct itself overnight. I know in a minute you're going to talk a little bit more about the valuations in the markets and how some of the companies at the higher end are actually leading that, but overall the market in a lot of cases is corrected already.
Yeah, I mean,
some of these companies.
I can jump right into that. I mean, if Kate will throw this next chart up about the S&P and shows the top 10 companies there in green that's highlighted, they're trading at 33 times earnings. Okay, that's just the top 10 companies in the S&P 500. The remaining companies are trading at just under 20 times 20 times earnings. So there's still some opportunity out there, but like we said before, you're just seeing a lot of growth in kind of high concentrated areas.
Yeah, and this kind of goes back to the chart I talked about at first, which is the valuations and the PE ratios are elevated. What we're saying here is the big part of that, the reason for that is a select few companies.
Right.
So we call those the high tech, and we're not going to pick on any companies, but seriously, there's been a huge amount of investment interest in companies like Google, Facebook,
Yep.
Microsoft, Apple, Amazon, Nvidia, you name it. And many of those we own. We're not shying away terribly, but we do feel like those are the ones that are more vulnerable to a pullback. Many of the companies in the S&P have already seen a 20% pullback. Most people don't even realize that.
Yeah, that's
They've
wild.
already seen it. So I can go through and pull out 100 companies in there that have seen from peak to trough already a drop of that level. I want to talk real quick the next chart about consumer finances. I know we don't want to spend a ton of time today. I don't want to bore you to death, but I do think it's important to get information in your hands so you know what we're dealing with. Consumer finances are in a much better shape than they were. So when people say the market's at a level it's going to crash, and I don't want to invest because it's going to crash. I mean, to us that's just silly. It just doesn't make any sense to just say it because the market's a certain level, it's going to crash. I remember when I first got into this business, okay, the Dow was trading at about 1,000, and people were writing books and saying, Dow 20,000, and they were getting laughed out of the room, and people thought it would never happen. It's never going to happen. Well, look, guys, we're almost 40,000 on the Dow. We're at 36,000. Okay, so it creeps up on you, but that's just the power of compounding. And so at some point in our lives, not too far into the future, we're going to see Dow 100,000. I mean, it's just common sense. I mean, it's not hard to understand this when you understand compounding. So when people start telling you it's too high, it's going to crash, it's foolish. And you look foolish when you say that. So please don't get into that conversation. Prices are going to continue to go up for the rest of our lives. They don't just reset and come back to zero. All right, so let's talk about why we don't anticipate a crash, and that's household debt is at much more reasonable levels. Look at this chart. Go over to the right, household debt service ratio. Back in the last major recession we had, which was 2007, we were dealing with 13% of our disposable personal income was being used to service debt. So that just means we were borrowing a lot more money back then. Consumers here in the U.S. had a lot more debt. Now we're at 9% of our disposable income servicing debt. Okay, so we're in much better shape financially. Down below that, we show our household net worth. It's continued to rise, and it's gone up substantially since 2007, the last peak. The last time we peaked out was in third quarter of 2007. Average household net worth was $70,000. Now it seems small to most people, but it's still a positive net worth. We've doubled, more than doubled since then. So we have 150,000 plus in current household net worth. I think that's important to realize. We're not skating on thin ice right here with the consumer.
Yeah, so if we do see a slowdown in the economy or some disruption, I think the point Billy is making in 07 when that happened, people were so overwhelmed with their debt, they couldn't make their payments, they couldn't get ahead, they fell behind, they lost their homes, they lost cars, I mean, just set into turmoil. And I think a lot of people got burned by that, and they taught their kids that too. And I think that's why you're seeing lower debt levels than what we've had prior.
Yeah, there's a lot of money in the economy. We've all kind of been talking about that, and we're not ones to get political too often in our videos. We don't like to base our investment decisions on what's going on with politics. I really don't like that. I shy away from that as much as we can. However, when that affects what we're doing with our investment strategies, we want to mention it. So some of the policies right now we're not in favor of. We're not in favor of sending out checks so people aren't incentivized to go back to work. I think that's a huge drain on the economy from getting back where it needs to go. It's a big factor for why business owners can't hire people. And if you think they can, go out there and talk to some of them. Go out there and ask why Chick-fil-A and Burger King and others are having to post jobs for $18 to $20 an hour just to find somebody to come in and serve fast food. It's not like it used to be. People don't want those types of jobs, and so they have to pay an arm and a leg, and that's why the prices continue to go up. The current administration, and I'll just say it, Biden administration, is completely turning away from any responsibility from that and acting like their policies are helping. Matter of fact, today I just heard they're going to spend $1 billion to try to help the small meat packing companies because they're telling us as consumers that the reason meat prices are going up is because of collusion with the meat packing plants. Okay, so again, I laugh at that in a way. It's hard for us as consumers to pay those prices. I agree with it. But they're the same meat packing plants that have been in business for decades. So what we're dealing with is too much money chasing too few goods creates inflation. That's economics 101. We're not going to spend our way out of it, and that's what they continue to try to do is spend more taxpayer money to get out of these problems, and it's just spiraling and continuing to exacerbate the problem that we've already created. So let's just make sure we understand this. We're not dealing with people who understand businesses, really. We're dealing with politicians. And we need, hopefully, somebody that has a little different approach to it in order to get ourselves out of this going forward. The inflation, I'm going to go to that chart, inflation and CPI. You can see how we are now going back up in a pretty rapid way our core headline CPI, which is just the consumer price index. It's just a measure of the prices of goods and services in our economy. So in November, it was at 6.9. The December reading was 8 or so. So we're talking about inflation jumping probably into the double digits here before too long. And we are going back on the increasing to the levels we haven't seen since the 70s as far as on an upward trajectory. Now we were here once before in, let's say, on the way down in the early 80s, but we're not on the way down, we're on the way up. So that took us a long time to get out of that. We had 2 or 3 major recessions during that period. So the job of the Federal Reserve is going to be very tricky.
Yeah, they've got a lot of work ahead of them, and you know, as we see rates start to increase, you're going to see that across different financial instruments like CDs or money markets or treasury bonds, and it's going to be tempting. And I want to explain that real quick to people. So right now the 10 years at like what, 1.8? So maybe we see that jump up, and what if it doubles? I mean, that's a huge jump to 3.6, and people are thinking, hey, I can get a 3.6% rate of return. But now you have to figure, well, inflation is at 12, okay? If we get into double digits, like Billy said, we're at a net real negative return. So that's what we as advisors are looking at. What's the real return? So don't get fooled, don't get tricked, don't get water cooler talk, what we say at work, you know. Someone's saying, well, you need to do this, but really consider what is your after inflation return.
So let's go into
and then taxes on top of that.
Oh, taxes too. So your real return is really, really negative. Let's go into the last part of this video, which is going to be how do we prepare for the future and what are we going to do about it, those things that we've talked about. We've talked about some concerns, the things that we're watching for. We've already taken a couple of steps down that road, but now we want to tell you what we're doing and maybe the things that we're going to continue to do or move further along the line. So interest rates and inflation, Shaun mentioned here. Bonds are going to be one of the worst areas I think we can be invested in. So we back way up on that. But this chart we have up now just shows clear back to 1958. The return on the nominal return, which is the actual stated return that the bond is going to pay, and then what we consider to be inflation. So it takes out inflation, and the after effect of that is called the real yield. So what's your real return when we factor the inflationary force after the nominal yield? So take a look at it right now. The last several years we've been in what's called a negative real return. And this is a measure of the 10-year treasury. So that's not going to change anytime soon with inflation going higher and treasury still staying at low levels. So there's very small or little reason to invest in treasuries, but you know why the Federal Reserve and Congress continues to increase our deficit and our national debt is because they assume people are still going to want to buy U.S. Treasury bonds. I mean, to really think about it, that's how we get the money to operate as a country, is they borrow, right? They borrow. How do they borrow? They issue bonds. So you issue more bonds, and you can't issue bonds unless someone is out there to buy them. And many of the bonds, a large majority of the bonds are going to the foreign investors right now. But there could become a time when the Chinese don't want to buy our bonds anymore. And that's going to be an issue. When we have $22 trillion of debt outstanding, and we have to keep selling government bonds even just to service the debt, but no one wants to buy the bonds anymore, we're in trouble. So we're kind of walking along a tightrope, in my opinion, is just assume people are going to continue to want to buy our bonds when we don't really know what the future holds. So I'm not in favor of this kind of debt, this kind of maneuvering with our leaders, but that's for another debate, I guess. We're just going to continue to talk about it. One area that I'm going to finish on here, and then Shaun's going to wrap up, is why we feel international markets still have strong potential going forward. This chart shows you since 1971 the periods of outperformance between international markets and U.S. markets. And as you can see here, the most recent time frame since about 2007 or 8, U.S. markets have outperformed, and it's grown to a level almost unprecedented. So it's been many years since we've had that reversal, and we're overdue for it. Typically, you only have 5 to 7 years of outperformance and then a reversal back to the other market. So, just go by time and history. We're looking at and telling people it's time for a reversal of outperformance, and we think the U.S. may have run its course.
Yeah, and I think just to hop onto that, with the U.S. outperforming, the U.S., if you look at types of companies, we're full of innovation, we're full of technology companies, so that's where you've seen this robust growth. If you look at international markets, you're going to see more banks, you're going to see more insurance companies, more of kind of what I would call your steady eddies. They do what they do, they pay dividends out to shareholders, and they want their price to increase too. So that opportunity, that shift that we're seeing right now, I think it bodes well for international markets, and that's why we're going to be allocating a little more dollars towards that in our models. So we said a lot, we went through a lot. If you have questions, please call us, that's what we're here for. But otherwise, just have a great 2022. Watch for our newsletter, that's going to be coming out here in the next little bit, so you can kind of see what we've all been up to.
Yeah, it'll come out soon, and again, we hope that you guys call if you have any questions, and we're here for you. But just know that we're not anticipating a straight up course. We had more moderate returns this year, probably low double digits or maybe high single digits for overall markets. But we're going to see several corrections along the way. So buckle up, don't be afraid. We'll talk to you again soon.